Yes, Sanjay, I believe we are good to go.
Okay. So basically, safe nodes have been very popular in global environment, especially in Silicon Valley, where a lot of the startups have been raising money through safe nodes, and many of the Indian investors, fellow family offices, and investors would like to invest in global startups, especially in early stage where you want to quickly close the round and raise money. Safe notes have been very popular, but let's try to demystify and decode across how does safe note work, what are the do's and don'ts, what are the drawbacks, and what are the right times when you should be doing across the safe note. I run a firm called 100x.vc. We are a first check VC fund, where SEBI registered, where we invest into first checks into startups, and this is sponsored by Mehta Ventures family office, which is mine. And in last 1 year we have invested in 29 startups in India. In my personal, as a Mehta Ventures family office, we would have invested in over 50 plus startups globally in various geographies, and I would say at least 80% of them were on safe notes. So just can you go to the next screen, please? Next slide. That's my email ID, Sanjay at 100x.vc, in case if you guys want to reach out to me. And at Mehta Sanjay is my Twitter handle, in case if you want to send some love. That's where you can follow me. I regularly write on Twitter. Thank you. Next. So safe notes are called simple agreement for future equity. That's the SAFE is an acronym, and it stands for simple agreement for future equity. Uh, it, it has been designed across to simplify early stage investing. Now going next. So safe document is an agreement between an investor and a company which gives a right to the investor to claim future equity in the company. Now, just to decode that, idea here is when you want to invest in early stage and the deal assumably is quite hot and people are wanting to be on the cap table and VCs are coming in. There is always a struggle between an individual investor, family offices, and VCs, everybody getting into that cap table. So usually venture capitalists would not like to have individual investor. They would like to have larger ownership of the startup, and that's where the struggle starts across. And for a quick closure, safe becomes very easy, where an individual investor can have one-on-one agreements with the startup. And what right it gives is when you put in a money, it does not give you equity at the same point, but it gives you an equity to the startup at the future whenever the company raises a price round. Now, what it means across, we'll take it up in the next slide. But in simple sense, you as an investor, if you are looking into investing into any startup, you would have right to the equity into that startup in future whenever it raises a price round. Price rounds are where there is a valuation decision, there is a price per share which is discovered across, and a larger round is getting raised across. Next. So this origin of safe notes, it started across somewhere in 2013 by a very renowned accelerator in US called Y Combinator, and they allow startups to be funded via safe notes. And there were various structures over the time which evolved across, and this has been very prevalent in Silicon Valley since then. And then it just spread across because of the simplicity, because of the ease of closure of transaction. This went viral, and across the globe, people are using in various formats. People have customized it, and they have made this open source kind of document where people can easily use it. So it's a short 5-page document, and it's like a standard template which does not require any legal lawyer kind of stuff. And the only thing which is negotiable in that safe notes are the valuation caps, and I'll make you understand what valuation caps means. Next. Next, that's just an illustration kind of stuff. Why is safe needed? Now, what was the need for Y Combinator, or why there is so massive adoption of safe notes, right? At early stage, how do you discover saying that what valuation of you will invest into startup? How would you price a startup? It's very difficult to understand across, and assign a value saying that this is the valuation of a startup. Very difficult to put a benchmark. Either you feel shortchanged if the valuations are very high, or startup founders will be feeling shortchanged saying that, oh, I sold my company at a lower valuation. So what SAFE does is it differs across that valuation discussion to a later stage. Whenever there is a price round, which means at a later stage, whenever company raises a larger round and there is some data metrics and there is a third party or a VC, which is a larger, kind of funding institution, when it discovers across a price at that point in time, you will be able to get the equity. That's how it works across. So basically, it's a convertible form or a convertible note which is converted into a security. What happens in a convertible note? Typically, it's a debt. Safe is neither a debt or an equity, and there is no interest accruing at the maturity date. So I'll just delve in detail in future, but just to understand, at early stage, it solves across a problem of valuation discussion. Many times, a great startup is available to invest, but because of the valuation discussion between parties and the deal, is lost across, and you lose an opportunity as an investor to invest across because you don't believe into the high valuation. So let's defer that to a future, and that's how the safe works across, where it secures across you the right to equity at the future stage whenever the valuation is discovered across. So it is very important, in early stage investing document, which has helped across many early stage investor get into the rounds, which typically they would not have. Now, there are two scenarios which can happen across with startup. One, where they are able to raise the round, you will get an equity. Second, if the companies fail, kind of stuff. So this becomes like a dead company. Then what was the fun of valuing just holding shares, because it's already going to be a zero. So it works both the ways. So if there is an upside, then you will be able to get your equity which was promised across basis on the valuation cap and or discount. So we'll understand the forms of safe note. But idea here is, you will be able to, using safe note, you are able to as an investor invest into global startups across the world without negotiating on the valuation and spending time. Next. So this is, I mean, as simple as that. Again, reiterating, it closes the transaction much faster. It's a simple and shorter version of all the shareholder agreements, and where there is no convert, like in a convertible note, there is a maturity date. This is not a maturity date, but there are trigger or the events which can be triggered across on types of notes which are there. And there is, because there, so you like a startup, you believe this is a great story, you've heard the pitch, you validated the founder, it has got a great market, you like everything, but usually the deals break on the valuation, and that's where safe comes handy. So there is not room for negotiations because you are deferring that valuation discussion in terms of how much equity ownership you as an investor will own to a later stage. So only thing which gets discussions are valuation caps, which are negotiated, which I mentioned earlier. But we'll get into detail in the next slides. Can you go move next? That's it. So operationally, it gives a lot of flexibility for founders and investors. This model, because there are not enough, so you don't have, great rights. It's a founder-friendly document, and founders have a, ability to raise multiple rounds on the safe before they raise a large VC round. So idea is they don't have an, see, in shareholder agreements, a lot of rights are very onerous on founders to go across. There's no need in the safe notes. There is no board seat. There are no other, very cumbersome rights on founders being able to raise rounds. They don't need consent. Let's say there are 20 other individual investors. They don't have to run around to other 20 investors to close the round. So it becomes very easy. And with safe, there's no requirement to fill with government as a regulator, and they can be very quickly closed across. So the only thing which you need to, as an investor, think across with safe is, do you like the deal and you want to be in that deal on the cap table, right? So if this goes up, this is going to be, see, when you do startup investing, your risk is 1x, which is your capital, but your upside is unlimited, right? It just is unlimited. And the success which is seen across in startup is always going to be into that top 5% of the deals which make that cut kind of stuff. It's very different when you invest in real estate. You invest because saying that, okay, this is a great, we'll get a predictable return. In startups, it's not like real estate. If you do 10 startups, your 5 will fail across. Maybe another 1 or 2 would give you 2x, 3x kind of, and 2 or 2 might be giving you just your capital back. But that one startup, which is going to be an outlier hit, will give you the complete alpha, which can get into 30x, 50x, 100x kind of exits. So the idea is you want to be into that deal as an individual investor, where you are not putting large chunks of capital like VC, but as an investor, you would like to still own that exit. I'll quote across my examples, the kind of upside which is possible. Like, I was an early investor in Oyo Rooms. We got 280x kind of return. Next. Can you just move to the next slide, please? So in shareholder agreements, what happens is every investor need to be on the same shareholder agreement. So when you do price round, all shareholder signatures are required, and there are processes which is there. Everybody has to agree to those terms, and there would be drag, tag, exit rights. There would be liquidation preference. So all these things are mentioned across in a definitive agreements, which are shareholder agreements. And the drawdowns, what an typical shareholder agreements is going to be together when all the investors sign. Whereas in the safe notes, you and the founder agree upon saying that, okay, you want to take the money as a founder, and investor is agreeing to invest money. You can have an individual safe notes, and each one of the investment can be called upon to draw down. So let's say there is a 2 months period where the startup is raising across, let's say, million, and there are 20 investors which are putting in that million, and they're at different amounts. And let's say you are putting in 100K into that company, you can just call for that 100K, or you can invest your 100K without even bothering across what's happening at the other investor end. So idea is startups get capital upfront. They start using and building the business while they are raising the next of the round. So drawdowns becomes very, very easy in the safe notes. Next. There are, 4 types of safe notes typically. One is cap, no discount, discount and no cap, cap and discount, and most favored nation, which is MFN, no cap and no discount. Let me just give you some insights onto that. Cap and no discount is where you will have across a valuation cap, saying that, let's say, for example, I'm investing at 5 million cap. Now, whenever I would invest across, let's say, 100K at 5 million cap, and the next round, let's say, happens across at 10 million, your shares or your equity issuance will be at 5 million cap, which means your ownership is now decided across at 5 million. Now let's assume the round happens across at lesser than 5 million. Then at 4 million, let's say the round is happening across, you will get your money at 4 million, which means at whatever the conversion of 100K happens across. So your lower cap is automatically protected, and the upper cap is already marked across. So because you have given money earlier, your valuation cap gives you more ownership whenever the price round is happening across, because of the valuation cap. Next is the discount and no cap, which means across is, let's say there is a 20% discount to the next round. So let's say you want to invest, you invested via safe note 100K, and the round happens across at 10 million, and there is a 20% discount, which means that you would be getting across your shares at 8 million kind of stuff. So that's a discount and no cap. Then there is a cap and a discount. So idea here is you have got a cap and a discount. So which means that you got a 5 million cap and there is a 20% discount. So same applies across. And MFN is the most favored nations where what it says across is the rights which you have across. Whenever the future investor comes across, your rights will be at par to the future investor, which means whatever liquidation preference, whatever in that rights would be available, that would be available to you as an investor kind of stuff, because rights become very important. So there is a construct which happens in this four variables between. So this is what you would typically negotiate with the founders when you are investing across. Next. At 100x.vc, we took this learning. When I was investing in US, my learning were great. The lots of funding which I did through safe notes in global investments. And in India, this was not prevalent, and most of us were doing onerous shareholder agreement at early stage. So we brought in this safe document and created a version of it called India Simple Agreement for Future Equity. And what it does across is works in a very similar way, but it is customized to Indian laws. And all our 29 deeds which we did across in 100x.vc were through India Simple Agreement for Future Equity. In fact, out of the 29 deals, we got for the subsequent round, or 24 of them could raise across. And out of that, 21 were through safe notes, which was a follow-on round being done across via safe note. In fact, you go to 100x.vc, you can download the India version of the safe note. It's open source. Anybody can use it like a template. There's no legal fee involved, and you can download and use it at your will kind of stuff. So you can go to 100x.vc website and look at the safe note document. Next. So what happens in India as a legally requirement of MCA, investor makes a cash investment in return of a convertible instrument, and safe note is a not a debt instrument. And as I mentioned earlier, and to comply with applicable Indian laws, it takes a form of a CCPS, which is convertible preference shares, which you get across compulsory convertible preference shares with on the occurrence of specified events, which can be whenever you raise a next round, this will convert at whatever the cap you would be having across. Next. So in India, if you have to understand iSafe, and iSafe is neither debt and or equity, as mentioned earlier. There is no interest, but for legal compliance, iSafe note carries a non-cumulative dividend of whatever negligible 0.1%. And so if startup fails, and if there is a money which is left on with the startup, then that would be returned to the iSafe note holders or the equity, the common shares, which means the founders kind of stuff. Before the founders get any money, you would be able to get that money and receive that amount. And there's no liability on the company, nor there's a liability on the company to pay back, but not on the founder. So it becomes a very founder-friendly document. It doesn't become like a debt. When you do convertible note, it's like a loan on the book, and which gets converted into an equity at a future state. So let's say if startup fails, they will have to repay the loan. In this, it doesn't happen across. Next. That's the link in case if you want to note down www.100x.vc/iSafe. You can download the documents over there, read the FAQs, and understand it with more details. There are a lot of YouTube tutorials. If you Google iSafe, you will get a lot of documents which are available. Next. Now we have seen the pluses of the safe notes. Now let's understand, what are the drawbacks. At 100x.vc, we believe iSafe or the safe notes are the best way to invest across. We use it personally. A lot of the investors have used it, but they are not for everyone. Like many of the investors who want to become or want to hold an equity from day one, the safe notes are not for them. There will not be enough rights to available to you at the first instance. Your rights come only whenever they raise the next round of money. So idea here is uh, anybody who believes that safe are a less secure investment, they would not use safe across. They would like to control startup, or somebody who is putting large chunk of money. Let's say you're putting 1 million, 2 million kind of stuff, and you want to hold across, control the startup or hold rights across. Then you would be focus across in terms of saying that let me just do it on shareholder agreement, where there is more control on investments kind of stuff. And many of the time, that ambiguity of saying that a cap discount, I just want to have my ownership clear cut before I invest into it. So then you would be focusing on a price round, do a valuation. But mind well, many of the startups have now started avoiding shareholder agreements at the early stage. Unless you are a very reputed VC and you are putting large chunk of money, they would not agree, and you would end up missing a deal if you insist on a shareholder agreement. Unless startup is desperate for money at early stage, they would not accept across shareholder agreement. That's a trend which is happening across. So you need to understand while you are using safe note what kind of drawbacks it has across. Mainly I feel across is the rights. Now my personal investment, personal view is, when having invested over 100 plus startup individually in last 10 years, and through 100x another 29 of it, my learning has been, what you are focusing on the startup is saying that if the startup is going to grow, you want to have be part of that startup which is growing across, own the equity. At that point in time, you want to be into that round, not being left out just because of shareholder agreement. So quicker, early stage startup is all about getting into the right deals very quickly. There are very few deals which will make success, and you want to be part of it. And that's why it makes sense across to invest closely. And if the startup is going to fail, doesn't matter whether it's a shareholder agreement or a safe note. If the money is gone across, there is no, the focus at early stage is not to salvage. So there is something which is called power law, where you work across. Failed startups don't matter. It's only going to be the startups which are going to create that outlier hit. Those matter. So it's all about home runs, not averages. Your focus should be saying that, is this going to create 100x kind of return, and you take a bet and invest into it. Next. So that's my final slide. What to take away. Silicon Valley, has been leader and cheerleader of safe notes. There have been, tons of deals, which I would say across at least 99% of the deals in the valley at early stage would be using across safe note, because it's cheaper to execute, quick to close transaction. You like a deal, you close it across, and it benefits both investor and founders kind of stuff. And it has now given that comfort, because most of the upside whenever happens across, VCs also like across, saying that safe note deals hai, it's easy to close across for the subsequent round. So that's where I would just close across, if in case any questions have.
Is there any method in which a retail investor can participate in a startup venture capital fund? I believe, is that what you mean?
Venture capital. So in India, there is a minimum requirement of 1 crore if you want to invest into any fund. In case if you want to invest into startups directly, then Safe Notes is the best way. You can go to 100x.vc website. Our portfolio is mentioned over there, all 29 companies. You can look at the companies which you like across. You can reach out to them directly, or reach out to 100x.vc, and they will help you connect with the founders, and you can invest through safe notes directly. But if you want to put into fund, then 1 crore is what is required across as a minimum requirement to invest into a VC fund.
Okay. Going to the next question from Sanjay Durgan here. Can safe notes be possibly used by a global startup that has already been funded in the first round to attract top management talent as different to ESOPs?
This is not a replacement of ESOP. ESOPs are quite different. This is more to entice across investors where there is a disagreement on valuations or valuation discovery is a challenge. And yes, safe notes are meant for global startups. And if Indian investors want to invest across on safe notes, it's very much possible.
Okay, there's a question from Jenny here. She's asking, can you invest on behalf of my client?
No, we don't. We don't invest on behalf of anyone. So you have to take your direct decisions on the startups. 100x.vc portfolio, we have funded it, so it's a valid deal. We have done the curation, we have put our money. Now you need to select which deals you like. We don't invest behalf of clients.
Okay, all right. Any other questions, audience? So Sanjay, I mean, till we get any more questions, any interesting trends or sectors that you want the audience to look, look at? Uh, I mean, I'm talking about startup space in India.
Sure. So, Aditya, the way we look upon is couple of trends which we see across. The future of work is changing, and there are lots of startups which are trying to work across in terms of how the future of work will be redesigned. The consumer behavior has changed across. There is a new wave of how do you monitor the work which is happening across. How do you engage remotely with all the employees? How do you create an environment which is a work friendly from home? So that is one sector which is growing very rapidly. Secondly, we are seeing across SME market in India, which was not investing in automation, has taken up like crazy, and they are just investing left, right, and center into automating things, and the digital adoption has gone crazy. So SME market, any solutions which are targeting SME market for automation is going to be big. Healthcare is going to continue flourish. Healthcare, mental wellness, anything doing to health and wellness is going to be quite interesting. Education tech is going through the roof. There are more things which are happening in education tech. uh, Fintech is going to be as popular. There was a lull with the lending space, but it is coming and picking up. And we are seeing across a huge, upside in media entertainment side of it as people were working from home. But we believe that it's a saturated market. It's more of a big boys market from that sector perspective. Travel and tourism will take another maybe 6 months to a year to come back, kind of stuff from that sector perspective. Agri-tech is huge in India because new reforms are going to throttle across the agri farm bill, which was there, is going to just accelerate agri-tech in India. So that's going to be a huge one. And lastly, if you have to look upon, there are going to be new marketplaces which are going to emerge. So how traditional banks, which were like giving all the services, got disrupted, the big e-commerce players like Amazon and Flipkarts of the world will get kind of broken up with niche marketplaces which are going to emerge across.
Okay. Now, audience, we've run out of time, but there are three questions. Sanjay, I'll ask you each of these three, but request you for a quick answer. So there's a question from Meghna. She's asking any ESG guidelines for investment you follow.
We don't follow from an 100x as an ESG guideline because we are a small proprietary kind of fund and we do first checks. So no, we don't follow any specific ESG guideline.
Okay, the next question. I can't see the name of this user. Do you see unicorns in near future and AI, automation, etc. on global front emerging out of India?
Usually in the COVID times, we saw across 6 unicorns getting formed in India. In fact, my LinkedIn banner says across that India would see across 100 unicorns by 2025. So I'm very bullish on India, and we should see across emergence of 100 unicorns, by 2025.
Last question I'll take from Samir. Can you give a bit of insights in regards to the use of four available options? What are the general reason of selecting one over the other?
Typically, this has been driven by founders, and there's a negotiation happening. So let's say what is the most favorable safe note for a founder is going to be saying that there's no cap, there's no discount, which means that whenever you raise the next round, you get it at the same at par. Now, what's the best option for the investor is to get a discount and a cap. So idea is that's where you the top and the bottom kind of, and you negotiate whatever best you can.